Did you buy crypto this year? Are you worried about the tax implications? Do you not even know where to start? Is there something you can do right now that'll help lower your tax liability? Stay tuned. Welcome back, everyone. Doug Burson here, CPA, and today we're going to talk about cryptocurrencies. I'm going to give you a high level, not everything, just kind of explain a little bit about what they are from a tax perspective and what to expect on your tax return, and then some major planning opportunities that can help you lower your tax liability this year while there's still time. And that last little bit is going to be huge because it may be going away next year. So let's get started. All right, so this is a huge topic and we only have 5-10 minutes to cover this. So I'm just going to hit the high stuff. If there's any particular questions, drop them down below, and we'll probably have to do another video later to cover more of the details. So what is a cryptocurrency? Not what is it from what you're thinking about, but from a tax perspective. And from a tax perspective, the IRS has ruled that cryptocurrencies are property. And that's a very, very important thing. They are not money, they are property. And so that affects how they're taxed, because property, when it is sold, is treated as capital gains, short-term and long-term. So what is short-term? Short-term is any property that you buy and sell in less than 12 months. Anything that you hold longer than 12 months is considered long-term. So that doesn't mean calendar year, that means 12 months. So if I buy it on May 31st, on June 1st of the following year, it's now long-term and gets preferential tax treatment. And what do I mean by that? What I mean is it will get long-term capital gains. And for most of you, that's going to be 15%. And if you happen to be staying in the 12% bracket, that's 0%, best tax rate there is, and it'll save a lot of money. But if you sell it in less than 12 months, that's considered short-term capital gain. And what that means is you get taxed at whatever your ordinary income tax rate is. So that can be a major difference. There's also something though called losses, because let's be honest, we can't all win. So some of us are going to take some losses. And it's important to understand that losses, when you net out against all your gains, so if you had 10,000 in gain and 15,000 in losses, the losses can offset the gain, but you can only use a maximum of $3,000 to offset ordinary income. So if you take a huge loss, it's not going to lower the tax on your W-2 except for a little bit. And it's important, I want you to understand that. I don't want you to have a big loss and think you're going to get to harvest it against your other income. It only works against against ordinary income except for $3,000. Now hopefully none of you had that, but let's be honest, some of us made some bad buys or whatever happened. So it is what it is. Now, that seems pretty easy. The problem is you don't buy one coin and then sell one coin. What do? We buy, well, it depends on what you're buying, but maybe you bought 30 coins of whatever it is, or Dogecoin, you bought a whole bunch of them. And then you sold them, and then you bought them, and then you sold them, and then you bought them, and then you sold them, and then you bought them, and then you traded them and bought something else. That all sounds fun and it's a hoot. It's like a video game. I'll be honest, I do it some myself. It can be a blast. The problem is when you go to do your taxes, you have to track that one coin all the way through all those transactions to find it. And if you trade a coin for another coin, the IRS ruled a couple of years ago that that's not a like-kind exchange. So if you traded Bitcoin for Ethereum, you're gonna have a taxable event right then based on the fair market value of whatever you traded it for. If you give cryptocurrency to somebody to buy something, when you gave it to them, you have a taxable event and you now have to recognize income based on the value of what you received. So let's say you, let's say you went and bought some wheels and the guy lets you turn in cryptocurrency to do it. You now have income based on the value of the wheels for what you traded that crypto for. A lot of us think if we just do that, we don't have any taxable event. We do, and the IRS has actually put together a group to go after people who are trying to cheat on this. So I don't want you to be surprised if that happens and think, I didn't know, because now you do. Another thing that's really blown up this year is NFTs. And those of you who know what I'm talking about, non-fungible tokens, may not realize they're taxed differently. So when you sell a piece of art, it's considered a collectible. And collectibles can be taxed at a rate up to 28%. Remember, cryptos, most of them are going to be at 15. Well, NFTs are treated like a collectible. So they are taxed like collectibles at a rate up to 28%. So it can be twice what a normal crypto is. And that's a big difference. And I don't want you guys to be surprised by that. So just know that they are taxed differently, and don't get surprised. Now, I already mentioned a second ago, the IRS is going to be looking for it, and there's actually a name for it. It's called Operation Hidden Treasure. And the IRS is coming after it with the criminal arm. So this is not something like you're just going to get a little misdemeanor and a ticket. This could put you in a real bad place. So once again, I've warned you twice in this video alone. Don't tell me later on you didn't know, because now you do. Okay, so now we're at the point of the video of why you all came here, and that's tax planning opportunities. How do we lower the taxes on these cryptos? And there's several things we can do, but one is what I want to call your attention to right away, and that's called wash loss sales. So in the stock world, a long time ago, they put a stop to this. And let's say you go out and buy a stock for $100 and it's dropped down to 50. So what do? You sell it. I know that doesn't make sense to you, but you'll see it in a second. You sell it. And what that did is that gave you a $50 capital loss. Now what happens? I go rebuy it the same day. You see what just happened? I just took a $50 loss. I rebought the stock at the exact same price, so nothing changed in my life, and I just harvested a loss that I can use to offset gains that I made on other stuff this year, and I still own all the same stuff. Great plan, works awesome. IRS said, you can't do that, and they put rules in place to stop it. But guess what? Cryptos aren't stocks. Cryptos are property. And so property, we can still do this, okay? And this is huge, and I really want you to understand this, because right now, especially if you bought stuff in the last month or two, you're probably sitting on a loss on some of those items. And I'm going to tell you that you need to look at the possibility, not saying it's right for you, but the possibility that maybe, since you bought high, you should do the opposite of what you think and sell low, okay? Sell low, harvest that gain, turn right back around, rebuy it. It's not illegal, it's still allowed. You harvest those losses. You can now use those to offset a lot of the gains you had this year. You still own the crypto at the same price, give or take. It'll change a little, but you know what I mean. You'll still have all the same stuff, but you just brought in a loss to lower your taxes. And we only probably have 2 weeks to do this. And this is why I wanted to make this video. This is very important. This is probably like a once in a lifetime kind of opportunity, because there's already mentioned in the next legislation that they're working on that effective of January 1 of next year, this is over and they're going to stop it. And clearly why, right? If I was writing the laws, I would too. But right now we can still do it. And it doesn't seem like they're going to make it retroactive. And if they do, no harm, no foul. You still got all the same stuff. But this is an opportunity, one time, you can get this done this year and lower the taxes, because I know a lot of you have had a really good year in cryptos, but maybe we're down a little bit on some of the stuff you bought. Sell it, let's lower your taxes, reset for next year, and worry about next year. Like I said, not right for everybody. Maybe talk to your financial advisor, maybe talk to whoever, make sure this is a good plan. The important part to me is I wanted to make sure you knew about it. Wash loss rules right now do not apply to crypto. Okay, I beat that, you know it. Now the next thing is, we talked earlier about how much you buy, you sell, how are we gonna track all that, right? Well, one, I want you to understand there's 3 different methods for tracking basis on cryptocurrencies. The standard is Fifo. That's first in, first out. So what does that mean? That means if you've started buying a particular stock in February, and you've been buying it every month, buying it every time there's a drop, you buy it, and now you want to sell something. When you sell, you're selling the very first one you bought that you still have. And so normally that's going to be the biggest gain and the worst tax situation for you. But that is the standard method. And that's also how the exchanges are probably going to report it when they do. And they're going to have to start doing that in 2023. But I want you to know that they're probably going to do it on Fifo, which may not be to your best benefit. There's another method called Lifo, and it's the opposite. It's the last in, first out. And so what that means is we started buying in February, bought. Here we are. I bought one today. I'm going to sell tomorrow. The one I bought today is the one I sold. Now that may be a really good tax situation for you, but think about right now. Right now we're in a hump to where it's come back down. So the one you bought today is probably cheaper than the one you bought 3 weeks ago. So your tax is going to be better than the first one, but it's still not going to be the best situation. But that's called Lifo, last in, first out. Now there's another method, and this is the one that I think most people are going to want to do, and it's called Fifo. And what it is, highest in, first out. Highest in, first out, Fifo. So like I just said, there's that picture. It went up like this. Highest one is this one. That's the one you bought, you paid the absolute most for. So when I sell tomorrow, that's the one I want to sell, right? Because that one actually you're going to have a loss, right? But the one that I bought back in February, if I sell it, I'm going to have a gain. Same sale price, completely different tax situation. Completely different. I lost money, I made a bunch of money. Which one do you want, right? You want most likely Fifo. Now that sounds great, but you can't just be willy-nilly with this. This takes records, it takes work, and it takes a lot of effort. And you don't want me to do that because on your tax return, that's going to be very, very expensive. But there is a solution, and I'm not getting paid for this, and there may be other alternatives, but I was looking for one for you guys, and it's called Coin Tracker. What you can do is connect Coin Tracker to your wallet, and then it can take all that information and it will do this to your best benefit, and generally that's going to be Fifo, and it will come up with that tax basis and give you a printout, so when it's time for us to do the tax return, you're going to get your best benefit. I've heard some people complain, oh, but it costs money. Well, I guarantee you it's going to be way less than if I have to go through this. So pay it. It's going to make your life better. It's going to give you the best result. And it's just going to make your life easy. So do it. And maybe later on if I have time, if I do, I do. And maybe we can do a video on how to use Coin Tracker, and maybe that would help. So we'll see. I don't know if I can promise that by tax season. There's not a lot of time left, but go look at it. It's going to be the way to go. Okay, so we covered a lot. We can't cover it all. Crypto is a huge concept. There's so much going on. There's a lot of opportunities, maybe setting it up inside of an IRA, maybe set up a mining machine in an IRA, all kinds of goofy stuff. We don't have time for that. I just wanted to give you guys some high-level ideas. Make sure you're aware of this. I know a lot of you are new to it. One, it's property. I wanted you to understand that. It's not money. Two, when you trade from one crypto to another crypto, that's a taxable event, or one crypto to anything, that's a taxable event. Don't be surprised. Three, you want to track basis, and I wanted you to understand the difference in Lifo, Fifo, and Fifo. I wanted you to make sure you understood about something like Coin Tracker, and then I really wanted you to make sure you took advantage of wash loss rules that are in our favor right now that may change. Not saying you have to, but I wanted you to be aware of it. So I think that's it. If you have any other particular questions, I'll do my best to answer. See you guys later.